Alright, let's get straight to it. Look, if you were watching the screens today, February 5th, 2026, around midday New York time, then you saw something that doesn't happen every day. This wasn't just a move, it was a repricing of fundamental macro assumptions. This wasn't noise, this was a signal. Gold hit an all-time high of $5,054 an ounce yesterday, only to see one of the most brutal, fastest corrections we've witnessed in years. A near 18% collapse from those highs. Silver saw an even more dramatic 37% plunge. Then, today, a partial recovery. That kind of whipsaw is not normal market behavior. It's a system under stress, and it's telling us something critical about where we're headed. Before we dive deep, do me a favor, tell me in the comments where you're watching from and what time it is for you right now. Let's see this global community connect. And if you're serious about understanding these seismic shifts, hit that subscribe button and type plumbing in the comments. We're going to talk about the market plumbing today, and it's absolutely vital you understand it. This isn't just another Tuesday, this is a macro moment. And to truly grasp what's happening, to understand why these moves are more than just daily volatility, you need to connect three critical threads. Miss even one of these, and you'll misunderstand the entire story that's unfolding. First, we're going to dissect the raw market action itself, specifically in precious metals, the dollar, and how the mainstream narrative completely missed the real signal beneath the surface. Second, we'll connect this to the macro, policy, and currency forces that are pulling the strings behind the curtain, focusing on the new Fed chair nomination and global central bank divergence. And third, we'll expose the market plumbing and positioning that turned a sharp correction into a cascading liquidation, revealing where the true vulnerabilities lie. Stick with me, because the deeper we go, the clearer the picture becomes. Let's start with thread 1, the market move itself. That brutal reversal in gold and silver? It wasn't just profit taking, it wasn't just a simple risk-off correction. This was a forced reliquidation event, exacerbated by factors that most commentators are either ignoring or simply don't understand. Think about it. Gold blast to an all-time high, screaming geopolitical tension, tariff fears, central bank accumulation, all valid points. But then it reverses with such ferocity, it takes your breath away. Mainstream media will tell you it's investors reassessing inflation expectations. That's generic, lazy analysis. A topping move looks different. A topping move usually involves distribution, a slow bleed, or a reaction to genuinely good news that the market sells into. What we saw yesterday was a violent, almost instantaneous unraveling. That tells me it's not a change in fundamental sentiment as much as a structural shakeout. It tells me there was leverage in the system, and that leverage got hit. Look at the dollar, rebounding sharply today, pushing the DXY back towards 97.80. A strong dollar almost always creates headwinds for commodities, but the speed of this dollar reversal, happening alongside the metals collapse, suggests a flight to safety out of leveraged commodity positions and into the reserve asset, the dollar. This isn't just about inflation or disinflation, it's about trust and solvency in specific market segments. Consider oil too. WTI moderating to $63.96 a barrel, Brent to $68.36 as news broke of potential talks between Washington and Tehran. Geopolitical risk premium coming out, sure, but the underlying narrative of supply constraints and rising demand from forward forecasts still projects higher prices. This tells you that for now, the immediate systemic stress is not energy supply, it's something else entirely, something related to the sudden, violent unwind of speculative positions. When you see this kind of relative strength in the dollar and such dramatic weakness in assets typically seen as safe havens against the dollar, you know there's a deeper structural issue at play, not just a simple market cycle turn. This wasn't a regime shift based on new economic data, it was a shakeout based on market structure vulnerability. Now, let's pull on thread 2, the macro, policy, and currency forces that are orchestrating this dance. The biggest news today, without a doubt, is President Trump's nomination of Kevin Warsh to replace Jerome Powell as Fed chair in May 2026. This isn't just a personnel change, it's a potential tectonic shift in monetary policy philosophy. Warsh is a vocal critic of the Fed's expanded balance sheet. He resigned in 2011 because he opposed quantitative easing. His view? That nearly $6.6 trillion on the Fed's balance sheet represents a distorted financial system. This nomination immediately strengthened the dollar. Why? Because the market is pricing in Warsh the balance sheet hawk. It's pricing in a potential shift away from the current Fed's measured approach, which recently saw 3 rate cuts in Q4 2025 and a pause in January 2026. While the Fed talks about data dependency and a nuanced assessment of a solid economy but low job gains, Warsh's history suggests a more aggressive stance on shrinking the balance sheet. But here's the kicker, the crucial distinction between what policymakers say they want and what the system rewards. Warsh faces what's known as a policy trilemma. He wants to shrink the Fed's balance sheet, which typically means higher long-term yields. But the Trump administration wants lower borrowing costs to fix a frozen housing market where 30-year mortgages are still over 6%. You can't have both easily. Shrinking the balance sheet dramatically could trigger a liquidity crisis, like the September 2019 repo market meltdown when the Fed's balance sheet was much smaller at $3.8 trillion. The market skeptical Warsh will go full hawk on day one, recognizing a funding market dislocation in his first months would be catastrophic. So, while the dollar rallied on the idea of Warsh, the reality is he's trapped between competing objectives, balance sheet reduction, lower rates, and financial stability. This dilemma has profound implications for metals. Gold and silver are trust instruments. They thrive when trust in fiat currency and central bank credibility wanes. If Warsh does try to aggressively shrink the balance sheet but the system can't handle it, and the Fed is forced to backtrack or intervene, that's a massive credibility hit. That's debasement. Conversely, if he takes the can-kicking approach of rolling maturities into shorter duration, that just defers the absorption of term risk to the private sector and perpetuates what he dislikes, monetary dominance. Either way, the underlying problem of fiscal deficits, compounding debt, and the Fed's outsized role remains. Look at the ECB and Bank of England. They're also paused, watching inflation, cautious on cuts. The ECB saw Eurozone inflation drop to 1.7%, BOE with a split decision, holding rates despite some calls for cuts. Even the Bank of Japan, under an 8-1 vote, kept its key rate at 0.75%, the highest since 1995, citing an improved economic outlook and higher inflation expectations. They're all playing this game of data dependency, but the incentives are clear. Avoid disrupting a fragile system while trying to manage inflation that's proving sticky, particularly in services. The common thread is caution and a realization that dramatic policy shifts could have unintended severe consequences. This global policy divergence creates currency volatility, strengthening the dollar against the euro, which saw a 5% appreciation recently, but then consolidating. These are all moving parts in a massive macro chess game. Now let's get to thread 3, the market plumbing and positioning. This is where the rubber meets the road, where the theoretical macro collides with the brutal reality of leveraged positions. That historic sell-off in precious metals, it was exacerbated by changes in margin requirements imposed by futures exchanges and clearinghouses. Think about that for a second. Prices go parabolic. The exchanges get nervous about the leverage in the system. They hike margin requirements. What happens? Leveraged positions are forced to either put up more capital or liquidate. In a market where prices are already correcting, this creates a cascading liquidation dynamic, forced selling, plain and simple. This isn't theory, it's mechanics. When gold runs from $4,000 to $5,000 in a relatively short period and silver sees similar, even more extreme moves, the amount of paper leverage stacked on top of physical metal becomes immense. The futures market, designed for price discovery and hedging, becomes a giant speculative casino. And when the house changes the rules mid-game by raising the ante, a lot of players get trapped. We saw a 37% decline in silver from its highs. That's a wipeout for anyone running serious leverage. It spills over, creating a broader risk-off sentiment because funds that are getting margin calls in one asset have to sell other assets to meet those calls. This isn't just about gold bugs getting shaken out. It's about the very structure of how these markets handle extreme volatility. And this points to a larger underlying issue, the deteriorating quality of global liquidity. The Fed ended quantitative tightening in December and started buying treasury bills at $40 billion a month. That should inject liquidity, right? But the effective federal funds rate, EFFR, is still drifting towards the upper bound of the policy corridor, and the SOFR IORB spread remains elevated. This tells us banks are still facing genuine funding tightness. They've deployed their liquidity buffers into financial investments, not into extending commercial and consumer credit. They're effectively saying, We don't trust the broader economy enough to lend, so we're keeping our powder dry or deploying it elsewhere. This structural liquidity problem, combined with the concentration of positions in certain assets, the data shows record concentration in mega-cap tech and unprecedented crowding in consensus trades, means the system is fragile. Leverage is pushing towards historical extremes. When margin debt is high and liquidity quality is low, any significant shock or change in pricing can cause rapid, forced deleveraging. The shift in Treasury holdings from the Fed's massive balance sheet to more price-sensitive investors like money market funds and ETFs also adds fragility. These players are quicker to react, quicker to sell if conditions sour. This isn't a market built for smooth transitions, it's one primed for violent swings. So, let's zoom out for a moment. This isn't about calling the top or bottom of a market. It's about understanding the regime. Those panic moves in metals, the forced selling driven by margin calls, these are short-term visceral events. They clear out excessive leverage, they shake out weak hands, and they can be incredibly painful. But what persists is the long-term trend of debasement. When central banks are facing policy trilemmas, when governments are running massive deficits that necessitate ever-increasing amounts of debt, and when the banking system is holding on to liquidity rather than circulating it, what does that tell you about the long-term purchasing power of fiat currency? Precious metals, real assets, they are trust instruments. They exist outside the financialized system of leverage and margin calls. Yes, they get caught up in the paper market's volatility, as we saw, but their fundamental role as a store of value when trust in the system erodes remains unchanged. Panic spikes fade, but the debasement trend, fueled by structural imbalances and policy dilemmas, continues. This correction might just be a powerful reset, clearing the deck for the next leg up once the dust settles and the implications of Warsh's nomination fully sink in, especially if the path to lower rates becomes entangled with a precarious balance sheet unwind. So, what's your practical framework for the next few sessions? First, watch market behavior versus headlines. Don't just read what happened, observe how the market reacted to it. Did good news get sold? Did bad news trigger a rally after an initial dip? Second, watch the closes. How assets close relative to their daily range and key support, G resistance levels, tells you a lot about conviction. Third, keep an eye on spreads, particularly the SOFR IORB spread, which is a key indicator of systemic liquidity health. If that widens, despite the Fed's T-bill purchases, it's a red flag. Fourth, leadership. What's leading the market? Is it speculative tech or defensive sectors? And finally, currency action. A strong dollar on Warsh's nomination means pressure on commodities and a challenging environment for global liquidity. But if that dollar strength is purely due to forced liquidation elsewhere, it's temporary. This isn't financial advice, but it is risk awareness. It's about interpreting the signals correctly so you can navigate this landscape. And this brings me to a crucial point about physical versus paper exposure. What we saw in gold and silver, that cascading liquidation, that primarily affects the paper market, the futures, the ETFs, the leverage products. When you own physical metal, you don't get margin calls, you don't get your position force closed. That's why leverage and margin calls are so important to understand in volatile markets. They are inherent risks in the paper game. ETFs and futures have their place for certain strategies, but understanding the difference between a paper asset vulnerable to these structural stresses and a physical asset that removes counterparty risk is absolutely vital. For those of you looking to go deeper, to understand the intricacies of these market structures and how to position yourselves without exposing yourself to unnecessary risk, we have exclusive research and frameworks that go into this in much more detail. It's about empowering you with knowledge, not just charts. To tie all three threads together, today's violent moves in precious metals, the repricing of the US dollar, and the shifting landscape of global central bank policy are all interconnected. The market's immediate reaction was a forced unwind of leverage positions triggered by exchanges tightening the screws on margin. This was a direct consequence of the macro and policy uncertainty surrounding the incoming Fed chair, Kevin Warsh, and his aggressive stance on balance sheet reduction colliding with the existing market plumbing and liquidity fragilities. Market behavior, especially under stress, tells you more than any headline ever will. It shows you where the leverage is, where the cracks are, and who is truly in control. This wasn't just a mood, it was a structural event. Have a plan, not just a feeling. The next few sessions will be critical as the market digests the full implications of Warsh's nomination and the potential for a real showdown between monetary policy goals and market stability. This is not financial advice, this is education. Stay sharp, stay vigilant, and understand the game you're playing, because the system is going to keep showing its hand, and you need to be ready to read it.